That's a little better. All right, now. Screen looks good. Everybody's happy. Good. Lovely, lovely. Anyway, so this is, well, yeah, all right, so that's 2, 3, 4, 5, 6, 7. So we peaked out in the first 1/3 of the month, like around April 10th, and then baboom, then collapse. So here's where OPEC started manipulating the prices back up. We went all the way up there, and now we're all the way back down here. That's not very good for them. OPEC does not have anything to do with natural gas. It's doing its own thing. Index-wise, these are daily. So index-wise, peaked out up here and we're coming down, peaked out, coming down, peaked out, coming down. Same thing though, we peaked out, coming down. This is why when you're at the top is a good time to sell your positions. And when you're at the, you know, why you don't wait until the thing collapses to sell. This is, people don't get that a lot. Everybody's, you know, when I did the portfolio reviews in April, that was the last straw for me. I mean, I thought this was silly in the first place, and then we doing the portfolio reviews, and I looked at it, I'm like, it's just, you know, you gotta get out while you can get out, while people are still buying stuff from you, because once it looks like you should get out, it's too late to get out. Then you're gonna have problems unwinding your positions. So you know, it just got to be a sort of a last straw for me last week, where, you know, I went over the reviews, I looked at the stocks, and I decided that, you know, there was too much uncertainty, you know, going forward, going into earnings, there was too much uncertainty. I felt we were very lucky to get back to here after having a banking crisis in March, hitting this bottom, and then rocketing back as if everything was fine, which it certainly wasn't. It was really kind of a last straw factor for me, as far as like one more thing has gone wrong with the economic uncertainty has been added to the pile, and now we're building a weak foundation to come back on. It made no sense. See, look, big volume selling, lower volume buying to get back to the same position. So that means you've got a less stable underpinning to the market. We still have the overhang of the banking crisis. We still have every other problem. No other problem has been solved during this time. All the other crap that was making us worried was still there, and inflation is still there, and people are being completely unrealistic about the Fed as well. I mean, that was also the tipping point for me, is reading the Fed minutes and the Fed meeting, where people, to me, are completely misinterpreting the concept. You know, and you know, here's what you don't hear from the analysts. And I don't honestly know. I mean, look, you know, obviously I'm an independent. I don't write for any major news organizations, which is good, thank God. You know, and thank you for your support. Otherwise, this wouldn't be possible, because I don't answer to advertisers. I don't answer to media companies. I don't answer to anybody. I just tell you exactly what I think is going on. And for whatever reasons, most people don't. And you know, and I understand that, because I used to have advertisers. For a while, we had advertisers, and they used to threaten me all the time. We're going to pull our advertising if you don't stop talking about this. We're going to, you know, if you want us to keep being your advertiser, don't talk about these things. That was like nonsense. And subscribers do it too, though. Frankly, I hear, you know, I lose people all the time who are like, "Oh, stop bashing Donald Trump. I'm not going to subscribe to your newsletter anymore." You know, everybody tries to control you. Anybody who's accepting money is accepting control, you know, to some extent. I mean, thank God there's enough people who aren't reactive, you know, who are willing to subscribe to a stock market newsletter. But, you know, everybody is there's a constant game of people trying to control what you say. And most people can't afford not to listen to that kind of stuff. That's why, you know, that's why Seeking Alpha freaks out if you say anything the teeniest bit political, because they know the letters start coming in. I used to write for Forbes. I was a featured column in Forbes magazine, and then they got threatened because I would say bad things about capitalism. This is back before 2008. This is before the market collapse. I would talk about the Occupy. This is the Occupy Wall Street thing. I was very active in that concept. And so when it started, when I used to start talking about the top 1% and the bottom 99%, they had people writing into Forbes saying, this guy's a communist. What are you doing? Why is he in your magazine? I don't want to read that. It's amazing to me. And Forbes had an entire staff meeting. They had an emergency meeting of their board and the editorial staff, and they took me off. Not only they didn't just take me off at the time and say, no, thank you, Phil, we're not going to carry you anymore. They redacted all the stuff that was online from the magazine. They didn't want to be associated with the, because Forbes' motto is we're the capitalist tool or whatever the hell they are. And they redacted me. They redacted the stuff I had written. It was insane. I've never seen anything like it in my life. I mean, you think the First Amendment is a thing, and then you realize what's actually going on in America. So anyway, so here I am still surviving. And, it's not a popular thing. It's not a popular thing for ratings either, for like, you want to get people to subscribe, and my position is cash. So what are we subscribing to? But the bottom line is it's not a good market environment. It's not a good time to invest. Oh, I'm sorry, unpopular opinion. So why don't people say this? Because everybody's got a master. Everybody serves a master, and I forget there's a song about that, but I forget what it is. But anyway, so everybody's got somebody they serve, and nobody wants to talk about the fact that the Fed is not the Wizard of Oz. They're just a little man behind the curtain pulling a bunch of levers and making an illusion of power. And it only works as long as you accept it. But the reality of the Federal Reserve is they can raise and lower the rate of the money that they lend to the banks. And that should set the interest rate. But that doesn't work when your government is $32 trillion in debt. And we have, in theory, a $25 trillion GDP. And by the way, I'm not sure I believe that, not to get into like, let's not be a total conspiracy theory here, but we had a $20 trillion GDP. Hang on, let's see if we can get an answer out of this. I think we're not going to get an answer out of this. All right. What is the US GDP? So 23 trillion, sorry. Oh, no, that's 2020. 23 trillion, 2023. 23 points, what? Yeah, $23.6 trillion by the end of 2023. But I'm saying they keep changing the way they measure it to make it bigger and they do the same thing to make the deficit smaller. So I think these are both bullshit numbers to some extent, but in hard fact, we have a $26.3 trillion GDP, even if you accept the numbers they have, and a $32 trillion deficit. Oh, sorry, it's 32 divided by 23.6. So our deficit is 135% of our GDP. All right, but again, they changed the way they measure GDP to inflate the GDP of the US, and they changed the way they measure our deficit to not count certain things or to count certain things over longer periods of time. So, you've got $1 trillion bill and you say, okay, well, it's $1 trillion bill, but we're going to count it as $100 billion bill for 10 years, not $1 trillion bill now. And so they stretch that out and make it seem like it's further off. I was alarmed, in fact, today because the deficit reduction, and by the way, you know, we're still counting on Google. We're still counting on Google to have facts, but it's getting harder and harder to tell what a fact is. And this is getting, it's going to be a big problem because you don't know, you know, federal budget deficit fell to 1.4 trillion as pandemic spending eased. They were talking about the compromise with the tax code, well, you know, with the budget deficit thing, although it's bullshit because the Republicans have a quote compromise plan, which no Democrat is going to vote for. So it's all a waste of time. And we're literally 2 months away from shutting everything down. They're not even close. Here you go. Republicans alter debt ceiling bill ahead of a vote. Raising the borrowing limit, blah, 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 blah. Republicans Save Grow Act would raise the debt ceiling until March 31st of next year. So all we're doing is giving it till next year, or until the debt ceiling increases by 1.5 trillion, whichever comes first. What do you think is going to come first? Oh, here you go. So the changes to the congressional budget said the proposal would cut government deficits by 4.8 trillion. That sounds like a good number, right? Over 10 years. What? So the Republicans are barely able to pass this so far, and it's not going to go anywhere. And all they're going to do is cut $480 billion a year for 10 years. That's cutting the deficit. There will still be a deficit, and it will still be massive, but they're going to cut it by about a third by 480 billion a year for 10 years. A significant reduction of the more than 21 trillion projected deficit over the same time period. All right, so let's keep that straight. So they're going to cut it by 4.8 divided by 21, 22%. So that means if we take 21 divided by 10, well, it's obviously 2.1 trillion. So 2.1 trillion times 0.78%, we're still running a $1.6 trillion annual deficit after this drastic cutback. And that's only going to last us until March, and then we're going to have to figure out what we do next. It's a joke, people. All right, so anyway, not to get into a whole lecture on this, but let's get back to what don't people tell you about the Fed. The Fed is not in charge of this. They're not in charge of the deficit. They're not in charge of the reduction of money. The other issue is that all these numbers from the CBO are based on a fake borrowing rate that doesn't exist anymore, because the Fed is artificially not raising rates as much as they should be. And where the Fed, where the dog pulls the curtain back in the Wizard of Oz, right? What happens to the Fed is, for us to sustain a 1 point, even if you pretend that all this other bullshit will happen, and you know something else will come up, and frankly, obviously something else will come up, because where's our $2 trillion to fix the climate? Where's that money? This number is short. This 1.63 is short $2 trillion to fix climate per year, every year for the next 20 years. That's basically what it's going to cost. And that's our share if everybody else in the world does their share. And if not, there is practically a direct result of the money you're going to have to spend on natural disasters and climate mitigation. There's a okay. So it's very simple. It's like if you just live in a house, right? Okay. So you live in a house and you spend X amount on at 80 or 90 degrees, you're going to spend so much money on issues like, let's say, your lawn dying, right? Which happens when it's too hot, right? So let's say you're at 90 degrees all the time and your lawn dies and you have to deal with that stuff, and you've got other issues, and you have water shortages, and you have air conditioning costs, and so on and so forth, and all these things that you have to do because it's so freaking hot all the time. All right. So then it goes up to 100 degrees, and now your lawn basically bursts into flames as soon as you put down the sod. Then it's like, then it's 110, 120. At a certain point, you're spending more on air conditioning and more money to get water, and now you got massive water shortages. Now you can't even bother putting plants down. It looks like Arizona. You just have dirt everywhere. And then the animals are all dying, and now you don't have food, and now you got to deal with that problem. And it's just one thing after another, after another, after another, because you didn't do anything about the temperature. So now you'll have to deal, if you don't do anything about the temperature, then you have to deal with the consequences of the temperature. One way or another, though, you're going to pay. Now, if you look back in retrospect and you could have done something about the temperature, rather than for the rest of eternity dealing with the consequences of the temperature, maybe in retrospect, you would say, I should have done something about the temperature when we have the chance, because now we just spend this money forever and ever and ever, and we're miserable because it's an oven, because we live in an oven now. Anyway, so at some point, one would hope that we become wise enough to spend the $2 trillion we need to spend. But meanwhile, that's more money of a deficit. So the question is now, where does this money come from? Because currently, the world funds a deficit by generally other countries lend money to each other, or people who make money lend money, whether they're private people or banks or other banks or whatever. People who have extra money, cash. You can think of Apple. Apple's got $100 billion a year. They got to put it somewhere. They put some of it into T-bills. They don't just buy companies. They put money into T-bills. What do you do when you make a ton of money? So corporations all around the world have this kind of problem. They buy T-bills, they do this and that. Governments invest in other governments to diversify their own holdings, because even a government doesn't want to put all their money in their own country. And then, of course, there's some money printing involved. People print money. China doesn't want to print money and buy their own bonds. They want to print money and buy American bonds with their fake money. And we want to buy Chinese bonds with our fake money, and so on and so forth. So when you print more money, a good way to hide the fact that you printed a lot of money is to lend it to another country, so the money bleeds into your system, right, via interest. So in other words, if I want to print another $1 trillion and put it into circulation, it's difficult to jam it into the economy and create 2% inflation. 5%, sorry, 5% inflation. So an extra $1 trillion would create 5% inflation if you just printed it and put it into circulation, because it's $23 trillion economy. So instead, you print $1 trillion and you lend it out around the world. So you haven't put it in circulation in this country. You've given it to various other governments around the world in a $100 trillion economy, or a global economy. And then you're going to get that money back, right, in your note payments. You're going to get interest back on the money that you printed. And over the course of the next several years, you stagger your bonds, right? You stagger your lending. Over the course of the next several years, money will keep coming back, and it will all seem very legitimate because the money, the bond matures and it's cashed and you get your money back. It's like laundering your own money. That's what happens in the bond market. So there's a combination public-private funding and money printing that goes on to create the global bond market. But the problem is the global bond market has been, let's say, I'm trying to think of a number that makes sense. It's probably about $5 trillion, 5% of global GDP. That's been historically the global bond market. So the global debt to GDP, or the global deficit, 5% a year, roughly. So $5 trillion. Now, the problem is that when we alone need $1.6 trillion, and Europe is also running a deficit of $1 trillion, and China and Russia are running $1 trillion deficits, and the whole world as a whole is now at a 10% deficit rate. Now we need $10 trillion. Now, where the hell is that money going to come from? So in reality, the global corporations are not going to make an extra $5 trillion. So they're not going to be a source of the money. The global wealthy people are not going to be a source of that money. That's just, it doesn't exist. So what the hell? Where is this money going to come from? Where are we going to borrow it? So we have to reach out further, try to tap the markets. Can we globally print all this extra money to buy our debt from each other and pretend that everything's fine? Only for a while, but eventually, as the money comes back in, it's inflationary. And if it's inflationary, then what happens is all of the private people who are putting the money into the bond market, they start the problem. They demand a realistic rate of return for their money. And that realistic rate of return for their money has got to be a profit in excess of interest. They don't just want to keep up with inflation. I'm sorry, in excess of inflation. They don't want to just keep up with inflation. They want to make their 4%, right? Everybody wants to make about 4%, 3% a year. It's fine to have these low interest bonds when the bond rates, when inflation is low, but once inflation is out of the bottle, then you've got to stay ahead of inflation, not keep up with inflation, stay ahead of inflation. That means that everybody's going to demand a higher rate of return from the bonds. That then means that the US government, that's already $32 trillion in debt. All right, and I don't know how much we get into the CBO report here. Let's see if it has a world government, could cut government. Let's see what kind of CBO report we have here. Now this is crap, I can tell already. But if we go to debt clocks, that'll tell us what the government's got. So interest, where is that number? Debt. There's our budget deficit. There's interest on debt, 560. So currently our debt is being calculated at $560 billion divided by $31,707 billion. So 1.7%. So our debt is currently being counted at 1.7%. The 3-year, the 5-year notes, 3-year notes, all the notes are basically at around the, wait, is it? Let's see. Treasury note rates. Yeah, 4%. All right. So I wasn't sure. The 1-year and 2-year notes are higher than the 3- and 5-year because people still believe the Fed is going to stop raising rates. In the short term, it's 4%. So for the U.S. to borrow short-term money is now almost undoable at 5%. We're forced to write 2-year notes. We can't borrow short-term because it's so ridiculously high now. But it won't be high because the reality is, like I said, the Fed doesn't have the power to pretend there's no inflation. This is why they've got to fight inflation. They have to fight inflation. They can't choose not to. Because ultimately what the Fed is doing is setting the rate that the Treasury bills are going to be. And if they're setting the Treasury bill rate and nobody wants to buy them, then the auctions fail and then the rates skyrocket the way that's what happened in Greece, right? You have a fake number, you keep trying to press it on people, and after a while, people won't pay the amount of money you're asking for. And what I'm saying is it's not even a matter of will of the people to pay it. It's physically impossible for there to be this much money in the world to pay our deficit and everybody else's deficit. Therefore, there will be a competition of rate raising in order to get the deficit. And in fact, I happen to be working on a project with people, with the government of El Salvador right now. And they're going to float $3 trillion worth of bonds, but the GDP of El Salvador is like $5 trillion. So think about that. Let's see, El Salvador. So the 5-year note rate, that's an interesting thing. So the El Salvador bonds, blah, blah, blah. So El Salvador's bonds are 6%. Okay, so a couple of percent higher than ours to start with. El Salvador credit ratings, coupon rate 7.7%. See, they're currently borrowing money, US 500 million, 8.5% bond. All right. So they were asking, and it's a consulting gig, and they were asking about, like, they're trying to float bonds and hoping to get like a 6-7% rate. And I'm like, how are you going to get a 6 and 7% rate when the U.S. government is paying 5%? It doesn't make any sense. You're not as creditworthy. You have to accept the fact that you're not as creditworthy as the United States. Look at this, El Salvador Republic, 9.5% 2052 bond. So the longer their notes are, the worse it is. And they don't get this. And I'm talking about the actual government does not understand this concept. Yeah, their GDP is $29 billion, and they want to borrow $3 billion. But also, so the reality is, though, they're going to be looking at something in the range of like not over 9% to put out bonds. Even government-backed bonds, they're going to put out 9% bonds. And that's, crazy. It's not but that's where everyone's going, though. And that's the point, though. They've got to borrow money. They have to house their people. They have to build solar projects. They have to do things to keep their economy going. And as you can see, it's actually doing quite well as far as the economy's, the GDP of the country has been on a great track. But to keep it on that track, they need more money. And it's very tricky. And El Salvador, by the way, is a country that accepts Bitcoin as currency. So if you start seeing countries resorting to 9% rates of bonds, where is this private bond money going to go? It's not going to go to America when they're offering 5% if somebody else is offering 9%. But El Salvador has to offer 9% because nobody's interested in their bond if it's 8%. So and so that's what I mean when I say they don't have the power. The Fed doesn't have the power to control what every other country on earth does. And Europe is way more concerned about fighting inflation than our Fed is. So tricky things ahead. And I'm sorry, I'm left up on this. So this is 1.7%, right? So what happens when we have a $32 trillion deficit times 0.04%, which is still not even a realistic rate? That's $1.2 trillion. This is at 560. We're going to be adding $700 billion to the deficit just as that's what the rates are now. Understand the 4 and 5% rates now. So as the current bonds roll over that are at 1.7%, they're going to roll over. We still have the debt. So we have to roll it over. Forget the new debt. We just have to roll over the old debt. Rolling over the old debt will cost us $700 billion a year. And since 90% of our debt is short-term debt, it's only going to be over the next 2 years that we're going to be up at $1.28 trillion a year of debt. So this number currently includes this interest payment, but this interest payment is going to go up by $700 billion. So this deficit is going to be $2 trillion. And the deficit that they're talking about reducing in these plans has nothing to do with changing the rate with changing the debt rate. That's not even included in their calculation. So all they're going to do when they cut $400 billion is mitigate some of the increase in the debt. And we're still going to have this, and we still haven't paid for climate change, and we still haven't fixed our infrastructure, which is also a $4 trillion bill. Cost of fixing U.S. infrastructure. Well, this one says 2.6 trillion. That's been 2021. I've heard 4 trillion. 2.6. It's probably not with the electric grid. 3.3 trillion by these guys. Oh, by 2039. Oh, 3,300 years. Sorry, not 3.3 trillion. Anyway, it's a big number. So big number needed to fix these. Let's say it is 2.6 trillion. We'll pretend it is. Let's see what that's going to do. Engineers say we just spent one. It's funny how we wouldn't spend the money for the infrastructure, but we did spend the money for the coronavirus. Spent more than that. 2.1 trillion to boost infrastructure over a decade would create jobs. We don't need jobs. That's the funny thing, right? Because we didn't do this when we needed to create jobs. Now we need to do it still, but we don't have the workers to fill the jobs for the infrastructure. So now it's like a different reason that we can't do it. Or if we do it, we would have to, it would be much more expensive. And if we do an infrastructure bill now and we spend all this money on workers, we're going to create an even bigger worker shortage and drive wages up even higher than before. This is the stupidity of inaction. I mean, it's unbelievable. When we needed to create jobs and infrastructure was a good idea, it was something we desperately needed. Had we done it then, think about how, had we done it then, we would have employed all those people when we needed to employ those people. They would have had jobs and put money into Social Security, and they would have contributed to the economy, and the economy would have grown. And even if they were now done with their jobs, we would be left with a more efficient electric grid, more efficient water systems, more roads, more highways, better dams, better hydroelectric projects, more power generation, things like that. That would be still here every day, improving America. But we didn't do that. And now we still need all those things, but we don't have the workers to do it because we ran out of workers now. Now, oh, and interest rates are higher, right? So, you know, we could have borrowed the money really cheaply and invested in our infrastructure projects and made all these improvements and done all this stuff, but we didn't do it. You know, and don't even get me started on why. I mean, you know why. Oh, it's crazy. Everything's crazy. It's a shame. Anyway, but the point was, the very simple point we started with is the Fed can't control all this stuff. Nobody can control everything. And the problem is we are giving the Fed way too much credit in being able to control this. And even worse, what people don't understand about the Fed is the only power they have is the power of the Wizard of Oz. Okay, so in other words, once you realize that it's just a little old man with a bunch of smoke and mirrors and so on and so forth running everything, it doesn't matter if you close the curtain back up. You still know it's a little old man with smoke and mirrors. And the Wizard of Oz, you look in front of you, the great big giant head of fire thing is no longer, it doesn't seem very intimidating anymore. It's just it's a trick. The Fed is like that. The Fed is a magic trick. And if they are exposed, they will drastically lose their effectiveness. Their effectiveness is based on the belief that they have the power to affect these changes. So to a large extent, when they make this bullshit, that's why these statements drive me crazy too. When they make these bullshit statements and talk about setting policy and blah blah blah, they cannot admit in their own minutes what's really going on. They can't say, well, we can't do anything about this. If global rates are going up, they have to come up with some bullshit reason to raise global rates, to raise interest rates in America, to follow the rest of the world, because they can't go the other way on their own. It's not going to work. To some extent, other central banks may follow the Fed, but not when the Bank of England says, oh, we still have 10% inflation. And believe me, we have our inflation, that's again, our inflation is much worse than it seems. How does the UK have 10% inflation and we don't? And you can say, well, Brexit screwed them up and whatever, but Europe is having 8% inflation too. So believe me, our inflation is not really going down the way everybody believes it is. And you know, the data we're getting now based on March is because everything slowed down in March. Everybody freaked out for a couple of weeks about the banking thing. And so spending decisions will put off, money purchases will put off, and it seems like inflation got lower for a couple of weeks. But that's a blip, and if that corrects back in April and May, and we're back to we're back to like 8% inflation, the Fed has absolutely no choice but to jam rates higher. But the point is, in England, the Bank of England has to. They don't have a dual mandate. We have a dual mandate so we can confuse people. That's the purpose of the dual mandate for the Fed, is so that they can come up with more reasons for why they don't do things the way you think they can. But the main reason is because they're not as powerful as you think they are. Just like, again, it's like the Wizard of Oz, who says, I can do this and I can do that and I can do that. But then when he can't do it, he goes, oh, that's because you didn't do this, or because this didn't happen, or what. It's not because he wasn't that powerful, but the real reason is he could never have done it in the first place. So bullshit. That's what the Fed is. The Fed is the Wizard of Oz. They can promise and talk about how powerful and mighty they are and threaten and do all these things, but the reality is they only have a couple of tools available to them. They can increase and decrease the supply of money. They can increase and decrease rates within the bounds of where rates are going internationally anyway. So their primary tool at their disposal is to be able to increase and decrease the supply of money, but increasing and decreasing the supply of money will then affect rates. So if you increase the supply of money, you're going to be increasing inflation, and that gives you less control of the interest rates. If you decrease the supply of money, which has been their goal previously, you collapse. Example, right? If you decrease the supply of money and you raise rates, then you are collapsing the banks and you're destroying the economy. And they can't do that. That doesn't help either. And in fact, the reason the debt ceiling crisis got pushed up was because the tax collections coming in for March and April, because the banking thing collapsed, were much lower than they thought they were going to be getting in March and April. So now the revenues are lower, and now that pushes up the time in which the U.S. is going to start being able to pay its bills. Right? It's a function just like at home, right? If you lose your job and you don't make as much money as you thought you were going to make in the next couple of months, then the time between now and when you completely run out of money grows shorter. Everything's connected, and people don't want to see it, and people like to pretend that they can operate independently of these things, but you can't. Every string you pull something on the other side. So that's where we are. And like I said, though, it's uncertainty, and all this stuff is, and again, I've said all this stuff before. I'm just putting it together in context, because it's not a light thing when I say let's just cash out everything. But at this point, we made a ton of money in our portfolios. It's too risky going forward. I'd rather go forward with new portfolios, even at this height, which I still think is better to wait. But even at this height, if I'm going to go forward, I'd rather go forward with smaller amounts of money that we can be more flexible on. If you want to invest cash, I'll talk to you. I can go to El Salvador for you, and we can put the money in at 9%. There's other ways to make money too. I'm saying there's plenty of ways to put money away and put it to use. There's these real estate projects all over the place that are worthwhile. There's lots of ways to make good money. But but the market is going to be very uncertain for a while, and we have to wait and see how the quarter turns out. And we may have to, be looking into a recession where things are going to pull back significantly. If we look at weeks or months, let's look at months. Let's look at big long term, right? So, we topped out here. 2022 was a terrible year in the market, and all we've done so far is bounce. All right, from 700, let's say 47 to 35, right, is 12. It's really like 48, I think. All right, let's make this bigger. Yeah, 48, sorry. So 48 to 35 or to 36, let's say, is 12. And that's a 25% pullback down to the bottom. So if it's 1200 to 36, then what's the bounce? The bounce is going to be 24. So 240 is a bounce. So from 36, we've got 240, which is 38.50 is a weak bounce. And then from 38.50, another, let's call it 250. From 38.50 is 39.41. That's a strong bounce. A strong bounce line is 4,100. That's where we are now. So all you have here is we fall from 48 to 36, and we bounce. A strong bounce is to 4,100. That's all this is. The downtrend is not over. Look at what large traders are doing. See large traders? What are large traders doing? They are getting the frick out. They were getting out. They are continuing to get out. Retailers are buying the bounce. Or hedgers, actually, like commercial hedgers, not even small traders. Small traders are kind of flat. Commercial hedgers are, of course, in the bounce. So people are trying to make money anticipating a move up. But the very large traders are getting rid of all of their stocks. Does the NASDAQ look the same? The NASDAQ doesn't look as bad. S&P not good. Russell's probably where the S&P is. Yeah, the Russell's out too. But the S&P, this is not good. That's a, I mean, look at it. I mean, when's the last time we've had something this bad? 2008 is the last time it's been this bad. And this is really, really bad. So is it an opportunity? Sure it is. Okay. Once we actually figure out that we're definitely bottomed out, there'll be an opportunity to get back in, because one day these guys have to get back in. When you want to be on that train when they start coming back, but we're nowhere near them coming back. They're divesting their holdings. Very large traders. Where are we? Okay. So what do we do today? I don't know why I should wait for that. We didn't want that. So today we are rebuilding, or we're looking towards picking new stocks for the future. We gotta think about what the big trends are going to be, and what's going to be worth buying, and what's going to be able to ride out a recession. So we go back to the watch list that we've always had. We started in December. I think I got it over here. There's no point in opening it. It's basically the same list, except that there were stocks that were already in our portfolio. So what I'm doing now is I'm taking the original list, I'm adding stocks like ARCC that was in one of our portfolios, and we've taken it out, and we want to now it goes back to the watch list. We don't throw it away. I don't take stocks that were in the long. Here's the let's say long-term portfolio. All right. So we're not taking these stocks that we like, and we just sold these puts. Look at all these puts we just sold in March. So a month ago, we sold a ton of puts. So every single one of these companies is a company we like. We currently like, we just decided recently that we thought these were worth buying. Most of them are on the watch list. That's where I got these from. But some are not. And I couldn't tell you right now for sure one that's not, but BXMT just had like nice earnings. Ha 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 ha. I'm very proud of that one. That was everybody's. Oh, and PacWest, they just had great earnings. There's another one I was behind. All right, let's see. Oh, here's Pat. Wow. Oh, is that there? They're up 13.5% today. See, we have the 10-15 spread, so we're going to be in good shape on. Well, we got rid of it, but we'll be in good shape. Anyway, so that's the point. So then things that came up recently, like PacWest, which went on 322, I don't know that it was in the watch list, but it's something I had decided. Oh, there's our old watch list. What do you know? Okay, well, let's use this one. Control F, PACW. Oh, they were there. So I had liked them at 2470. They were on the watch list, and then they dropped half of that down to 12, and that's when we added them to the long-term portfolio. See, in March, so we added them to the long-term portfolio from the watch list. This is what a watch list is for. So I knew I liked PacWest, but I was worried about the banks, so I didn't want to buy it. So instead, we put it on the watch list. Then, when I'm looking at when something happens like a bank failure, I look at the watch list and say, what banks do I like? What banks have I already looked at and gone over? And don't forget, we started the watch list in December, and the watch list was I think it was 60 stocks at the time. It was about 60 stocks that had been getting into the finals. And again, out of a couple of thousand stocks we look at for the, well, we look at all of them, I mean, but we screen out most of them right away. But then there's about 1,000 or 2,000 stocks make it through the first round of screening. And then as we pare down our stocks, we eventually get to like the top 100. So of the top 100, these guys made the cut to stocks that I would like to include in the portfolio, especially if they got cheaper. And that's what this watch list was. So all of these stocks have been very heavily researched and checked into, and we've already looked to see if we think anything's a flaw, so on and so forth. So given that now, whenever something happens, whenever there's a sector that's out of favor or a sector that starts to come back into favor, I say to myself, oh, let's go look at the watch list and see what's on it. So when the banking crisis hit, we were very quick to see that Barclays, BCS, and PacWest were companies that we wanted to jump into. That's the point of a watch list, right? Who am I watching? And when something hits the entire sector and my watch list company goes down with the sector, but there's no specific reason that they should be down, and that's when we go into the next round. That's when we say, okay, let's add these to the portfolio. And that's exactly what happened on March 22nd. So I guess if we look at specifically, okay. So March 22nd is what, around here. So, you know, it collapsed. We didn't jump right in the second it collapsed, but once things seemed to be stabilizing and it was at $10, we were like, oh, absolutely. That's what the watch list is for. In December, I said, I like them, and if they get cheaper, I'd be interested. They got way cheaper. But then we made sure that the crisis seems to be passing, and then we checked each bank out carefully, decide which ones we still want to add. These guys made the cut, and that's where we jumped in. And now they hit earnings, and it turns out, yes, they are okay. So still a great pick. And in fact, this is a $50,000 spread. No, $25,000 spread. Sorry, $25,000 spread. It is still only net $10,000. So it's got 150% upside, 150% upside potential without even selling puts. That's how you invest. It's not complicated. Who else are we watching? I would love to buy any of these stocks if they get cheaper. That's a rule of thumb. Also, though, when I'm looking at my watch list, like PHM was just there. There's so many here. So PHM, right? So PHM, we were watching from 50. So again, goes back to most of the, if they mostly started in December. So at around 50 bucks, when it was 50.70, I wrote, it's 7 times earnings. It's not too much debt for a home builder. And unfortunately, though, they took off and never came back to a lower price. So I'm not going to buy them. But I am going to learn that I should watch my home builders more closely before they all get away from me. So it's just because something gets away from you doesn't mean it's not good information. It means that I liked PHM. I liked where they were. I was right about them, but what other home builders are in there? And maybe there's some home builders in here that haven't gone away yet. So Apple, and it's very simple to go through. It's obviously visual. It's like, okay, Apple, well, high in the channel, so we're not going to be buying them. ACAM, should we look at ACAM? Yeah, when they have earnings, we see what's going on. That's worth looking at. Allstate, I've liked insurance. I was right about Met, so they're probably a good one. Amazon, as I noted here, just anything in blue is something I recently went over. Stupidly cheap, just stupid. Okay, I wrote it. It's only $1 trillion valuation, and 2022 they lost money. That's billion, not trillion. Minus 2.7 billion dollars in 2020. But they should be making. Boy, I got stuck on trillions, billions. These are billions. They should be making $20 billion in profits. In annual profits, which is just no. I could be wrong about this whole thing. 102.50 is $1 trillion. So if they're making 20 billion, that's 50x. Forget this whole thing. Okay, see, I gotta proofread this. So that's not right, because it's not stupidly cheap. Am I crazy? Am I doing this wrong? AMZN. Amazon. $20 billion between 14 and between 15 and 25. So if they're going to make $20 billion and they're at $1 trillion, oh no, that's not 5x, that's 50x. Oh, so they're not stupidly cheap at all. They're still expensive. Sorry, ignore that. Got to edit that. So that's why we check it, and we check it again. Good example. You can't assume anything is right. I feel bad about that. I got to change that. All right, APD, APO, ARCC. Where is this stuff? Boeing just had good news, and the good news is what we expected it to be. They're going to start making planes. That's what they're supposed to do. It's like Willy Wonka reopening his chocolate factory. It's going to be great. So they're gonna cycle back up. It doesn't matter what they make this year, what they make next year. They've got orders for Boeing backlog. Aircraft production backlog facts. See, 31 a month. Plans to ramp up to 50 a month. That'll be 600 planes a year of the 737s alone. So they're currently doing 30 a month. They're going to do 50 a month. 767 3 a month. 777 3 a month. It's going to go to 4 a month. Very exciting. 77 3 a month. Go to 5 a month. So none of that matters at all, right? The only thing that matters is this: they're going to go from 30 a month to 50 a month in the next couple of years. Okay. They do other stuff, but let's just imagine that, well, I mean, probably you can ask Google this too. What percentage of Boeing revenues comes from 737 production? Well, where does most of Boeing's revenue come from? Here you go. Commercial planes, 32%. But that's not really going to be accurate because the problem is 737 max, 8% lower operating cost. You got, I mean, the problem is they haven't been making any. Oh, here you go. Boeing plans to do 787 planes a year. Revenue jumped 28% last year. Oh, continue that supported. Free cash flow between $3 and $5 billion. They're going to go from 38 later this year to up from 31 a month. Revenue up 28% as a company narrative net loss. So let's assume that, for argument's sake, it's 1/3 of their total revenue, and they're going to double it, right? So they're going to have a 30-something% increase in revenue at least. It's probably more. Here we go. Probably more because they haven't been producing 30 a month in the first place. So last year didn't include that. And that's why, so they're going to go from a deficit to positive. They're at 120, and they're going to go from 3 billion here, and they're going to increase the 737 deliveries. They'll be more like this will be where they're at, 8 to 9 billion. That's a good place to put it. So let's say they go to $9 billion. So going forward, you're talking about a $9 billion revenue on a $121 billion company. So Boeing, when you're buying it now, and you think you're paying, even if you use this $3 billion, you're paying 40 times earnings. But in reality, it's going to be $9 billion, and you're only going to be paying about 12 times earnings, or 13 times earnings, whatever it works out to. So that makes them, that's going to make them an interesting stock, and we don't want to let them get away for sure. Boeing's one of those companies you absolutely want to own, but it's got a long way to go, and it's nowhere near where it used to be. But that's the kind of stuff. So again, the watch list, that's what the watch list is for. Boeing's on our watch list. We liked them at 190 when we started them on the watch list. They're at 200 now. They haven't gotten away, and the prospects are more like what I thought they were. And I wrote at the time, I said, they're only expected to make $1 billion. There's no rush to buy them. They used to make 8 to 10 a year, which would make 113 billion crazy cheap as they move to an investing cycle to a sales cycle with 7 years worth of back orders. So in other words, it doesn't matter if they're going to ramp up to a level in 2 years and sustain it. They've got 7 years to work off their back orders, and they'll get more orders while the back orders are being filled. So that's a level they're going to be sustaining going forward for a very, very long time. Bank of Argentina, is it Argentina? Yes, Argentina. Argentina Bank, really super cheap right now. Still cheap, even though it got away, like went up. Barclays is another bank we want to buy. Big Lots I kind of gave up on. Booking, look, travel was the premise of ours. It took off. BlackRock still cheap. This is a little retailer. It's not important, but it's really good. BNTX is a undervalued biotech. It was 160, now it's 110. So it's probably really compelling down here. But what we got to do is figure out how badly did the COVID hit them, and what can they do, and what's their plan for the long term. Here's Berkshire. We added those guys. BXMT just had that good report. Still stupidly cheap. This is really, again, we got to look into it more, make sure that we understand where we're at, but this is too cheap. All right, that's a total add. Citibank, another bank we liked. Cheesecake Factory, Caterpillar came down a bit, I think. 160 would be a gift, I said. Well, we're nowhere near 160, so I guess not. Oh, I see. They were up here. We were hoping they would go lower. They went up and then down. Still not cheap enough then. I guess not good enough. Capital Financial still cheap. Chimera is still cheap, as we had that for sure. Cliffs we always like when they're cheap. Comcast we picked up, I know, and now it's off to the game again. Chevron too expensive. Delta. This is how you go through the thing. And then when you and look at all the stocks. We're only in the D's. That's how we rebuild our portfolios, and that's how we're going to rebuild our portfolios. And we're certainly not worried when we can go through it and say, you know, cheap. So there's 2 at a time, right? So cheap. Half these stocks are still basically in a place we want to buy them. GNRC, we love them. Google just had earnings. They were not too bad, but they weren't too good either. They were pretty much where we thought they'd be. Microsoft had great earnings though. Honeywell just had decent earnings. IBM, of course, we buy no matter what they say. IEP is still cheap. IP still cheap. So in other words, only when I start going through these and I only see a quarter of the stocks is still cheap, do I start getting worried and say, boy, we better start buying some things, right? But if I have 100 names on this list and there's 25 that are still cheap, I'm not worried. We can't buy 25 new stocks for our portfolio. Not unless something drastic happens, which is what happened when we did all these put sales. 23. Basically every single one. See, March 22nd, March 22nd, March 22nd. On March 22nd, we picked 23 out of our watch list of things that we wanted to buy. Why? Because we had that exceptional crash in the financials. So we went through the watch list and picked about 1/4 of our watch list and put them in as short puts. And we said, you know what? If it gets any cheaper, we'll be happy to buy them. But there's 2 things that happen when the market sells off sharply. And again, we'll go back to on the chart. Here we are. So here's March 23rd. So we had gone way down. We seemed to be recovering, and I got confident that we would recover. So when we came down a little bit more again, I decided this was going to be a good day to buy. And what's the thing here, though? It's the VIX. Because when you have that kind of volatility, the VIX is very high. If the VIX is very high, then the short puts are expensive. And if the short puts are expensive, we want to sell them, not buy them. We don't want to buy calls. Calls are expensive too. We want to sell puts. That's step number 1 towards establishing an ownership position in the stock. So we went to our portfolio. And because before the crisis, we had cashed out all the puts because I was worried about the sell-off. So we cashed in all our puts. Now we had plenty of buying power for these things. So we sold all these things and for quite a lot of money. And this is as of today, we're up, 1.5, 2.5, 3, 4, -3 is 1, 2, 2.5. 1.5, 2, 3, 4, 5, 5.5, 5. Ooh, wiped out. Probably negative at this point. So let's say -5, 500 positive. Oh, thank goodness for that one. What the hell's that? ISRG. All right, so up about 8,000, 9,000 minus 85, 65, 75, 95, 10,000, 11, 12.5, 13, 14, 15, about $15,000 worth of gains. So that's in a month. That's pretty good. So netted $15,000 worth of gains. We had one really bad one and one really good one. The really bad one was GNRC, which dropped lower, but we love GNRC, so we don't really care. ISRG, we also love them, but they actually behaved themselves and popped up. So when we're reestablishing short puts, I'm more interested now in GNRC than I am in ISRG because GNRC got a better price. And now when I go to resell it, I can resell it for $36,350. Whereas if I go to resell ISRG, I'm only going to get $10,000. That's not even worth it anymore. You know, we got an incredible, but wow, what does their chart look like? Yeah, look how they popped, right? Holy cow. Okay. That explains that. Ooh, ugly. What the hell? Well, things are falling apart. But that's like I said, oh, what I see, that's what I said this morning. The dollar was down at 101. That was keeping the markets up. As the dollar has now popped back up, you know, this is what they do. The same guys, the large investors that were here, these guys, right? What they do is when they're trying to sell their stocks, they manipulate the dollar. The dollar is very easy to manipulate in the short term. In the long term, it's impossible to manipulate. In the short term, you can make it do loop-de-loops if you want to, because it just doesn't take a lot of movement of money. And for these guys to move money around is nothing. It's like, it's just, they do that every day anyway. So they just control how they move their money today, and they determine where they put the dollar. So as I was saying earlier, oh, where is this? Futures. No, oh, that's what we were looking at. So as I was saying earlier today, don't pay attention to the rally because it's based on the fact that the dollar has been jammed down. It's a trick. You got to learn what these tricks are. So the dollar was jammed, it was manipulated lower to mask the selling that was continuing from yesterday. So it would entice people to jump in and think there was some kind of bounce or whatever. And that let the big boys just keep selling and selling and selling. Look at very, very large volumes up here, you can see. And then once the dollar hits a floor, there's only so much you can manipulate it before other buyers in other countries start swarming in, saying that's too cheap. So once the dollar hits a floor and it starts going back, then the market shows you its true nature, and we're selling off. But that was obvious from the moment we opened this morning, which is why I put that warning. In fact, I think I mentioned it. I think I mentioned it in the post as well. Maybe. I don't know if I did. Said Microsoft had great earnings, good news, jumps, blah, 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 blue chip. Nope, I didn't mention it there. I mentioned it when we started, when the bell rang. Ooh, this is long. Oh, wow. Gonna run out of room here. Here we go. As I did note it above. The dollar's down to 101. That's almost 1% off yesterday. So anything less than a 1% gain in the indexes is nothing to celebrate. The big boys are still selling. That's what I meant. So that's what I meant when I said that. D-O-L-L-A. Oh, I did say it. I knew it. There you go. If the dollar hadn't been shot back down. All right. I say it all the time. It's just got to. Oh, look, it's the first chart I used. I say it all the time. You got to pay attention to this stuff, though. This is such an important part of trading. You've got to keep your eye on the dollar because the stocks are priced in dollars and the commodities are priced in dollars. So if the value of the dollar changes, the fastest way to manipulate the market is to manipulate the dollar. But the trick and the thing you got to know is that it can't stick though. It's the same problem the Fed has, right? You can, for a day or two, you can manipulate a price, you can push it a certain way, but in reality, the global markets then start paying attention and trading against something. They're like, well, that's not right, that's too low, and they'll push it back to where it should be. And of course, FRC is still dying. I don't know if they're dead yet, but they're on the way out. I don't think there's any rescuing this. It's going to be gone. And when did we talk about that? We talked about that yesterday because I could see it yesterday. I don't need to wait. All right, what did I say about that yesterday? I forgot. Phil's post. Oh, there it is. See, my headline from yesterday. So, this was my entire thing to worry about yesterday. It was $100 billion in outflows. I said, I don't care what they're pretending. That's $100 billion in outflows. And that means that, profits were down and they're not coming back. This is a problem. How are they going to come back when they used to have, okay, they had $176 billion, right? They now have $100 billion, but $30 billion of it is short-term loans made by other banks to them. Short-term deposits, not technically loans, but deposits that were done short-term to shore up their financials, because otherwise they would go from 176 to 76 and everybody would freak out. But why would you not freak out just because somebody dressed up the window? So I was saying yesterday, that's what I was talking about here. They're effectively dead. They're not coming back because they don't have the money that they had back here. There's nothing to come back from. They're not that bank anymore. They're a broken shell of a bank. So I said this is their dire. I said keep in mind this is their dire situation after other banks chipped in $30 billion to shore up their balance sheet, and they'll be wanting their money back. And the FRC can't survive, or I said it's not likely to survive, and we don't know how many other banks will reveal an issue like this. So please remain cautious. And again, when we talk about why did we go to cash, this was one of the reasons, because this stuff hasn't been resolved. A few weeks ago, they pretended to resolve it, but I said until you see that the money has successfully moved off the balance sheets and the losses have been realized, so either this had to be all shuffled off the balance sheet or the losses had to be realized. Neither of those things have happened in the case of this company, of FRC. And we don't know how many other banks are like this. All right, but FRC was, like Silicon Valley Bank, catered to a very wealthy clientele, and the very wealthy clientele pulled all their uninsured deposits out of the bank. So this is not going to, so on the one hand, yeah, there are going to be other banks that are like this. On the other hand, though, it's not really every bank. There's plenty of banks who don't cater to these kind of people. When you court the big money people and they will quickly move their money from one place to another, you court them by offering them a higher rate of return or easier terms or so on and so forth. There's different reasons that people will bank with you. Like Silicon Valley Bank, okay? Major hedge funds would put their money in Silicon Valley Bank. Silicon Valley Bank, in return, would lend money to their projects. So a hedge fund manager could walk a guy into Silicon Valley Bank and say, "Hey, this guy's going to open up a bank account. You're going to give him a line of credit of $10 million." And the bank would say, "Well, based on what?" And they'll be like, "Based on me telling you he's a great guy, it's a good company, lend him some money." And then they're like, "Oh, okay." That's how it worked in Silicon Valley Bank. I mean, if you knew somebody, but again, these people are depositors in the bank, and the bank is making money on the depositors. So a hedge fund, so like Sequoia Capital or something like that, is bringing you into Silicon Valley Bank, and Sequoia Capital has $1 billion in Silicon Valley Bank. So Silicon Valley Bank is making 1%, 2% just on the fact that this guy's put $1 billion in, and that's 10, 20 million a year. Is that right? Yeah. So so let's say that's $20 million a year. So they're making $20 million a year because Sequoia Capital has this money in the bank. Plus probably other things that they do that make the bank money. So let's say Sequoia Capital is overall good for $50 million a year. So when Sequoia Capital tells Silicon Valley Bank to open up a credit line for somebody, they basically say, "Yes, sir." And Sequoia Capital, it's not in a vacuum, because Sequoia Capital will do what they can to make sure these companies come out well, and they will, they're not going to ruin their reputation with Silicon Valley Bank, so they will make sure that most of their, you know, if they open up a line of credit for somebody and the company's faltering, they'll make sure the bank gets paid, usually. But the point being that the bank is sitting on a lot of questionable loans and a lot of questionable lines of credit that they put out and extended as a courtesy to their major account holders. But then all of a sudden, Sequoia Capital starts going, oh no, you know what? We're a little bit worried about your bank. We're going to pull our $1 billion. So now they're going to pull their $1 billion. They're no longer going to make sure Silicon Valley Bank is made whole by the companies they've extended credit to as a favor to Sequoia Capital. And Sequoia Capital goes somewhere else with the money, leaving Silicon Valley Bank holding the bag. That's the kind of stuff that happens to these banks. When you play with these powerful people, you can get screwed on a whim. And so, you know, most banks, and no bank should have been doing this in the first place, obviously, but that's just the game that they play. It's like dealing with the devil, right? You bend a little here and you bend a little there, and eventually you don't realize it, but you're just totally screwed. You have no choice. And notice I said that you know, I picked, and I was saying, so based on what I just said, I said banks that have a large amount of uninsured deposit, low net margin, high loan deposit ratio, weak capital position, significant exposure to troubled sectors, regions, blah blah blah. These were my two baddest of the bad. Is CMA and Zion are both banks that are in very big trouble. These are ones that I think are obviously in trouble. So that's why they hit my radar. You know, and I'm not looking to short the banks. I mean, you can, it's fun. You go to zero, you make a ton of money. But basically, I just think they're in trouble. And again, if every one that collapses, and they're trying to space them out, that's what the Fed is trying to do right now. They're trying to space out the collapses. They can't make nobody collapse, but they can space them out and try to buy some time, like they did with FRC. And they're just going to try to make it so that a bank fails this month and the bank fails next month, and it doesn't feel like a big crisis. If, you know, 3 or 4 slaps in a week, all of a sudden everybody's going to freak out and panic again. And that's the danger. And that's why, by the way, that's why the big banks lent FRC $30 billion, because the danger to them, these $1 trillion banks, is that there'll be a panic. And a $1 trillion bank can end up losing hundreds of billions of dollars because people panic. So they'd rather all chip in 30, not 30 billion each. I mean, these are $1 trillion banks like Citibank and Goldman Sachs, JP Morgan. They'd rather chip in a few billion each to shore up FRC for another few weeks, even if it's risking the $30 billion, than allow FRC to tank right after the other banks tank, and then people start pulling money out of JP Morgan and Goldman Sachs. That's not worth it to them. And again, the Federal Reserve and the FDIC. The FDIC doesn't have anywhere near the money to cover this stuff. Not even close. I mean, I'd be surprised if they have $20 billion. How much money does the field? Look, somebody asked that question before. Oh, 128 billion. Sorry, not 28 billion. All right, so they got $128 billion. Oh, but that was as of. So who knows what they're at now? Because that would have gone pretty fast. That's before the crisis, 128 billion. Before they decided to insure every single deposit in America. And apparently Silicon Valley lost $100 billion. So, oh yeah, I'm sorry, that is back to 28 billion. So they you know, we're never going to learn what that number really is, I don't think, but it's probably way, way lower than what it was. FDIC at a glance. As of December 31st, no. So 128 was official here. I don't know how they're going to re-put. See, now, for the FDIC to restock after a collapse like this, they have to turn back to the same JP Morgan, Goldman Sachs, Citigroup, Bank of America. Those guys don't have to replenish them. The government doesn't replenish the FDIC. It's the Federal Deposit Insurance Corporation. They have to pay insurance money into the FDIC to add up its reserves. So it'll be interesting to see what happens. But see, it would be bad to have all these facts at our fingertips because people would just panic more. So is everything going well? Yep. Okay. So we're holding up a little bit. Doesn't look too terrible. Not an uncontrolled drop, but all the way to 2 o'clock, we were dropping and dropping. So let's see. Do I have Bing on this thing? I think I do. Yeah. Let's see what Bing knows. Oh, new version of ChatGPT is so slow. According to finance results, what does that mean? U.S. markets are down today. The Dow's average index is down 0.51. The NASDAQ is down 1.2%. No, it is not. Oh, it's so annoying. It's not even down. It so pissed me off. You can that's not an answer even. Really? Let's do a new category, new topic. What is driving the market, the stock market? Let's be clear. The stock market today, April, let's say 26, 2023. Ugh, come on. Okay, let's see what you can figure out. So Microsoft and Google both reported better than expected earnings and revenue. Potential acquisition. Oh yeah, that's right. Because Europe, that's a biggie. So Europe is wants to kill the Activision deal. Alphabet's first quarter earnings showed a 2% rise in search revenue. That's interesting. Far below corresponding quarters from the last 2 years. So search revenue has taken a small hit, but not yet. But meanwhile, Bing is so small still. Meanwhile, installations of Bing app have quadrupled. This is where Google's in big trouble. If they have a drop in search revenues, people are going to freak out. First Republic Bank recorded earnings widely surpassed tax estimates, but a 40% plunge in deposits. Shares tanked to a record low, closing at. And remember, this is a cover-up, right? So this is what I mean by a cover-up. When you read it, it says they reported a 40% plunge in deposits in the earlier quarter. But like I said, that's after they've been shored up by $30 billion to make it seem like it's not as bad as it really is. They slash headcount, that doesn't matter. It's been reported the bank is trying to sell off. This is where they have a $100 billion shortfall. They're trying to sell the loans and securities. But when they sell the loans and securities in a panic, they're going to have to realize those losses. And then that takes you back here. Here. All right, so the problem for First Republic Bank is when they sell $100 billion worth of securities, even this is their year. $1 billion profit, $1 billion, $4 billion, $6, nothing, it doesn't matter what that is. So they're good for $1 billion a year, maybe $1 billion 5. If they sell $100 billion worth of stuff in a forced panic, and a lot of that stuff is going to be treasury notes and things, they're going to take a 10% haircut, even if it's just a 10% haircut, and Silicon Valley Bank took a 20% haircut, even if it's just a 10% haircut selling off their assets, that's going to be $10 billion loss on this company. negative 10 billion. That's going to wipe out all of their profits for the last 10 years. Who's going to invest in this? It's a dead company. So where was that? Oh, that was me. See, you got to specify. That's the trick. You've got to tell it exactly what date you mean. Otherwise, it just makes shit up. You got to keep it confined to a certain space. The fallout was promptly felt, and then you've got to read all the links to make sure these are actual links from real articles. The fallout was promptly felt in the markets, regional banks, blah, blah, blah. The KBW fell 4% down the whole banking index. Launch banks also bore the brunt. UPS is dropping 10%. Company said it faces higher costs due to labor shortages, fuel prices, lowered their guidance. This is not going away. That's the other thing I keep pounding the table on, right? It's like labor. It's not going away. It's not getting better. There's nothing being fixed here because we are still completely underpaying the workforce. And, you know, and inflation has only made that so painful that they have to overcome whatever fears they ever had of asking for raises, and they've got to get out there and ask for raises. And France is still on strike. They're freaking out over there. And worries over a debt ceiling showdown and creeping into the U.S. options market as investors were increasingly concerned that lawmakers will be unable to hammer out a deal, potentially sparking volatility, blah, blah, blah. The Treasury Department is wanting to run out of cash by mid-May. Oh my God, it's mid-May now. It was mid-June. Holy crap. Mid-May, the freaking April's over. Oh my God. Again, why did I go to cashew? It's a lot of good reasons. Recent news. News Corp stock falls on Monday. Well, that's not Tucker Carlson. That's not new. What happened with News Corp again? Blah, blah, blah. Oh, all the news is about News Corp according to these guys. That's interesting. What is your opinion on Microsoft's acquisition of Blizzard? How can I invest in Bing? What does Bing think is important? How do I invest in Bing? It's funny. I don't have a personal opinion on Microsoft. It asked me to ask that question. That's so funny. Why did you ask me that question? I don't have a personal opinion. I can tell you what some people may think. People may think it's a smart move by Microsoft to expand the gaming. Others may think it's a bad idea for Activision Blizzard fans and employees who will lose their creative freedom under the autonomy of Microsoft's control. That's funny. This won't work. It'll crap out on me. Watch. How have you lost? Wait a minute. How have you lost your creative freedom and autonomy under Microsoft's control? It's gonna kick me out. Is that not hilarious? I'm sorry, I don't want to continue the conversation. It might be time to move. Let's start over. That's so funny. So others may think it's a bad deal for Blizzard fans and employees who may lose their creative freedom and autonomy under Microsoft's control. All I did was feed the question back to them. That's so funny. All right. I'm sorry. I didn't want to make you blow up. It's too funny. Anyway, what are the pros and cons of FRC as an investment? Given all we know to date, April 26, 2023. Be interesting to see what his take is on this thing. FRC stock has been severely affected by the global financial crisis and lost about 80 cents since the beginning of the year. The stock closed at 8.10 on April 26. That's correct, down from the previous day. The bank reported better than expected earnings and revenues for the first quarter, beating the Zacks consensus by 70%. Wow. I don't know if that's true or not. The bank has strong capital position with tier 1 leverage. Oh my God. See, this is a problem with these things. The bank has a loyal and affluent customer base with an average of positive 1 million. A loyal and affluent customer base. Yeah, well, that's really kind of what went against them. They've diversified revenue stream, interest income, 60. Wow. Low cost funding structure represent 94%. Wow, that sounds great. They all right, credit risk, loan portfolios, concentrated residential mortgages, commercial real estate, construction loans. High exposure to California and New York, which are among the states most affected by COVID. Bank suspended its dividend, preferred common. Bank faced intense competition. The bank stock is trading at a low value. See, it's just completely useless. That's a shame, right? Because I mean, conceptually it should work, but it doesn't. It doesn't it's hard to tell why it thinks all these things that are not right. But that's the problem with AI. The real problem is that it doesn't make connections the way we do. It doesn't hold, it doesn't understand that it says something that is completely wrong. It doesn't even have an inkling. So it'll just say whatever and then, or read whatever and use it as a fact. So if it reads something and thinks it's a fact, it's going to run with it. So wait, what is this thing from? Yahoo Finance. So, you know, they're not questioning whether that's a good source or whether it's current or whether this person knows what they're talking about. And in fact, frankly, this is written by another AI. This is Zacks. This is the Zacks things are just spit out by AIs also. So, you know, these numbers do not tell the story of what's really happening in the bank. But this thing takes that number because that, you know, it takes Yahoo and is authoritative. I don't know if it cares, if it even understands that this is by Zacks, but it says Yahoo's an authoritative source. These numbers are then what it's going to go running with, and it's going to just take, and you see where the numbers are coming from. They're coming from this article. And you would think nothing is wrong. But that's because this article was written by an AI that took all the numbers on their sheet at face value. Whereas I'm taking the same exact numbers and saying, oh, they're in big trouble. Because I'm focusing on what really is going on here and what the problem is. And this is what's scary though, because it's hard for me to dig through the bullshit. I have to work harder now to dig through all this crap because I know to ignore that thing from Yahoo, because I know that if I see something from Zacks, that is Zacks and Motley Fool is even worse. And Zacks and Motley Fool use computers to write stuff. CNET just got in trouble for doing the same thing this year. So CNET, Zacks, Motley Fool, who knows, and who knows who else? Because these AIs are getting better and better. It's hard to tell it's hard to tell what's real and what's not real. But the problem is that they can give you completely false information and have no idea that they're doing it. Not with their intent, but just because that's the way they work. They run with whatever numbers they see. And when the sources they use are other AIs that are also running with numbers they see, how the hell do you get to the truth of the matter? It's very frustrating. You know, and so again, I think and I'll tell you, one of the outcomes of this thing is going to be that I don't think I don't think we're going to be able to invest in small cap stocks anymore. I think it's going to be too tricky. I think that, you know, to some extent, we're going to be able to rely on the spreadsheets and the data from blue chip companies, but we're going to have to read the 8Ks directly and check out their earnings reports and listen to the conference calls. And we're going to have to make our own decisions without reading all this bullshit, because you don't know where these articles are coming from anymore. It's very scary. So, you know, we've got to adapt our own trading styles to account for this sort of thing. I mean, fundamentals are still fundamentals, but you've got to be sure that you're looking at the right fundamentals, and you've also got to be sure that your understanding of the industry is correct too. So when somebody talked about, I don't know, an ESG portfolio or whatever the hell, somebody asked me if I want to do something like that, and I said no. And one of the other reasons I don't want to do that is because, like, let's say lithium as a sector, right? Investing in lithium. I don't know what's true and what's not in that sector, and I don't know the articles that are being written on the demand, on the supply. They don't know shit. I read so much contradictory crap that people don't know what's going on. People don't understand. It's lithium. My thing about lithium is that it's not rare at all. There's lithium everywhere. It's just a bitch to extract, and you're back to the same concept as getting gold. There's gold in lots and lots of places, but you've got to strip mine the crap out of it. It's in short supply, but it exists. Lithium's not even in short supply. Lithium is actually in plentiful supply, but it's in small concentrations in plentiful supply. And so you've got to dig up, like when you're digging for gold, right? You've got to dig up a mountain to get a ton of gold. And that is environmentally a catastrophe. That's why it's a shortage, technically. But they will improve their techniques, and it's so early stages. They will improve the techniques. We used to use a pickaxe, and we used to use pans in a river to get gold. Now we use bulldozers, and we get much more gold than we used to get. We produce 5 million ounces of new gold per year. So, here we are at the pickaxe stage of getting lithium out of the ground, and Caterpillar hasn't built the machines yet to extract lithium in mass scales. But once they do, the people who buy those machines are the ones that will make money selling lithium at 1/10 the price that it currently is. So, when you're in the early stages of these sort of things, like graphene is another one, things like that, they're in short supply until they start getting produced. Then they're no longer in short supply. Then they become a regular commodity. And there are very few things that are going to be in short supply. There has to be physically a lack of supply. So oil kind of qualifies there. There's actually oil is the second most abundant liquid on the planet behind water. So there's quite a lot of oil, and we burn it. Water gets recycled. We burn oil. We destroy the oil, but we recycle the water basically. Your car doesn't pee oil. It doesn't come back out, but for us it goes all the way through. So the shortages are just supply-demand discrepancies due to the difficulty of extraction. If you could just take all the oil out of the ground at will, there would never be a shortage, right? And if you could distribute it properly, there would never be a shortage. It's not about that. It's about whether or not the channel to get the oil from here to there and the cost of doing so matches up with the demand for the oil. That's what regulates the pricing. Lithium's the same thing, but at these early stages, when you start imagining that you're going to get rich based on some commodity, it almost never works out. It very, very rarely ever works out like that. There was a platinum craze a couple of years back. What happened to that? Nothing. It caught up. As much as we're using more platinum now, people shifted their attention to getting platinum out of the ground, and all of a sudden we got much more of it. So you got to be very careful about any kind of faddish investing. Oh, then there was coffee. Where's that? Joe. Actually, we can go to the coffee chart. So here's the ETF for coffee. And we jumped in on the short-term portfolio. That's how you make money on a steady commodity, because coffee here in November, so in November, coffee hit a level that we decided was too cheap. And that's based on the fact that we know how much it costs to produce coffee, and we know how much it costs to transport the coffee and so on and so forth. So there's definitely a steady bottom price for coffee, below which it becomes unprofitable for the farmers to grow it. Now, it can be unprofitable to grow, yet they'll still grow it because they're coffee farmers, and what else are they going to do? Or if they can switch to other crops, then they will. That's what most farmers do. Most farmers have more than one crop they can grow. Coffee is a little bit unique. It's hard to switch, but you know, so your supply and demand are going to be more based on weather conditions and whether or not there's a profit in selling it. But still, when you get down around this level, you start affecting the marginal coffee producers, and they will produce less coffee. There's no point in producing if you can't make money doing it. They'll just stop producing and tell the workers to go home. I mean, it's not, you're not going to hire all these people and have them pick coffee and sell it at a loss. Well, what was the point? You should have just gone on vacation. You could have spent the same money and had fun. So, you know, there is a bottom to coffee. We picked the bottom, we called it here, and we said it will go back up. If there wasn't likely to be an El Nino and stuff is around the weather, the overall weather conditions on the planet, therefore wasn't likely that we were going to have any bumper crops of coffee. And so the play we had expires in June, so that'll work out. Well, we closed it, but the point is that did work out. With a net $9,000 profit on a net $8,000 spread. So it made 100% basically that spread. So that's how you make money on commodities, because you know what the cycle is, you understand the supply and demand picture, and you step in when it's incorrect. But you can't just jump all over these investments at early stages, because the dynamics are constantly shifting. So you got to be careful about that. Also, you know, and also because lithium is a problem, everybody's looking for alternatives to lithium-ion batteries. Oh, and the other point I made was lithium does get recycled, in fact. So when old batteries are decommissioned, then more lithium comes back on the market, because then you just open them up and get the lithium out, you recharge it and put it in the new batteries. So only a temporary shortage at best in investing and stuff like that. You know, so, you know, we're going to look for good, solid things. We're going to be very wary of a potential for a recession. We'll be keeping an eye on the data, and we will be looking for, and we'll be looking for lots of new investments in the next month or two. Okay, and probably we're going to start our new portfolios after the middle of April, when expirations. When will expirations be in April? 19th. So yeah, somewhere around mid-April, we'll probably start doing adding these things back in. There's a holiday here, but that's okay. I mean, we can start building our portfolios in a couple of weeks, and that'll be the main topic of conversation on our next couple of things: is building the portfolios and starting it up. And then we're going to have a good couple of months of talking about all these basics of options and portfolio planning and all kinds of fun stuff. So that's how I plan to spend the next few months. And thank you all for coming. I appreciate it. All right. So we'll do it again next week. Take care, everybody.